It's been a very volatile week in the market already with the news in the semiconductor AI sector, but also along with that, we have a lot of companies that are reporting their latest quarter's earnings, and the three that I want to focus on in this video are going to be Starbucks, the company I own in my portfolio, Microsoft, one of the largest positions in my portfolio, and then also Meta, a stock I don't own in my portfolio but has tremendous dividend growth potential. So let's go ahead and start digging into it, and we'll start off with Starbucks. Now, we can see on the day, they were up about 8.14%, so obviously sentiment is high after the most recent earnings report. They're trading $108.58 per share, and now after the past year, they're down by about 15.76%. Now, if you're not familiar with Starbucks, it's been quite a ride over the past year. We can see back in late April of 2024, there was a huge sell-off, going from about $88 per share all the way down to $72.50 per share. And this is around the time where I started adding a few shares to my personal portfolio, and it's also when they released a disastrous earnings report. And so it traded lower for some time, and then it was announced they hired Chipotle CEO Brian Niccol, and sentiment shot up around this stock. Now, with all that being said, let's go ahead and look at the results. We can see they beat on top and bottom lines. Q1 GAAP earnings per share of 69 cents was a beat by 2 cents, and revenue of about $9.4 billion, which was flat year over year, but they beat expectations by $90 million. Now, let's jump into the earnings presentation to get a better understanding of what's going on. Now, before we even begin to look at this, I want to point out something that I thought was actually pretty interesting. I was reading what analysts had to say about this recent earnings report, and here's one that I thought was actually somewhat humorous. We can see an analyst from Bank of America noted that Starbucks sees minimal impact from higher coffee prices. This is a really interesting statement, and let me show you why. First off, we can see coffee prices over the past 5 years have absolutely surged. They've nearly tripled during just a 5-year time period. And if we look at just the last year, again, it's almost up 100%. But if we look at the results for Q1 North America segment, here's what we can see. Change in comparable store sales was down 4%. Change in transactions, down 8%. Now, their change in ticket was up 4%, meaning people are spending more money when they go to Starbucks. But here's the big kicker. Look at operating margin. 16.7%. What was it in December of 2023? 21.4%. So we're talking about a massive difference in margins. So when I see a statement saying that they're seeing minimal impact from higher coffee prices, I have no idea how you could come to that conclusion. Now, to be clear, I think Starbucks' problems are much larger than just the commodity prices rising. For example, if we jump over to my profitability spreadsheet, plug in Starbucks stock, look at the change in profitability for this company over the past decade. We can see right here, 2014 gross profit ratio is about 30.1%, and for 2024, they finished at 26.84%. So yes, we're seeing not only over long periods of time profitability is decreasing, but we've even seen over the last few quarters that remains true. And to a large degree, operating margin going from 21.4 to 16.7% is a big deal. So yes, I am hitting the low points for the company, but we'll come back and talk about why the stock is up so much. If we scroll down, look at international segment results. We can see pretty much the same is true. There are some hardships here. Change in comparable store sales, down 4%. Transactions, down 2%. Change in ticket prices, down 2%. And margins are a little bit lower, but not to the degree we saw in the North American segment. So with all that being said, why is the stock up by about 8%? Well, let's step back for a moment. Look at the dividend metrics for this company. Come up here and plug in Starbucks. Here's what we can see. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. But here's what I want to point out. Yes, the starting dividend yield, it's decent. But look at the growth in dividends over the past decade, going from about 55 cents per share all the way up to $2.32. So they're sitting at a 10-year dividend CAGR of above 13%. Historically speaking, this company has provided good shareholder returns, but free cash flow growth has really slowed down. So what's the focus for the new CEO, Brian Niccol? Well, during the company's earnings conference call, the CEO said the company has been focused on getting Starbucks back to becoming a welcoming coffee house environment and returning to sustainable growth. He said there have been positive signs in the core business, including a shift into a higher percentage of coffee-based and espresso drinks. The plan he laid out is that he's going to optimize the menu offerings, resulting in a 30% reduction in total beverage and food items, and the company also plans to deploy digital menu boards fully in the US and launch a pilot at 700 stores that looks at staffing levels to optimize the Green Apron's partners' ability to serve the world's finest coffee with a moment of connection. So it sounds like the huge focus is he's trying to get Starbucks back to what people used to love it for. Not just the coffee, but the experience and the environment. And keep in mind, people already had very low expectations for this earnings report, so it didn't take much to beat expectations. So all in all, it's still clear Starbucks has their work cut out for them. We're clearly in a turnaround play here. But I think if you're a Starbucks shareholder, this earnings report was really as good as you could hope for it to be. And the market seems to agree. Next up, we have Microsoft. And at the time of this recording, it's down about 4.43% after hours. So for the second consecutive quarter in a row, we're seeing a sell-off. It's now trading at about $422.74 per share. And before the sell-off, it was up by about 8% over the last year. And if we look at the earnings report at a high level, Q2 GAAP earnings per share of $3.23 was a beat by about 13 cents. And revenue came in at $69.6 billion, up about 12.2% year over year, and was a beat by $790 million. Now, if you don't know anything about Microsoft stock, if we jump over to our stock screener, I've already plugged in Microsoft. Here's what we can see. Everything looks phenomenal. They're growing top lines at a high rate. They're growing earnings, free cash flow at a high rate. Debt to assets level looks to be in a very healthy range, and return on invested capital has been above 20% for 4 consecutive years. So obviously, we're talking about a high-quality company, a company people are typically willing to trade a premium for. So for example, look at the forward-looking price-to-earnings ratio. It's sitting close to 34.3. So what's the reason for the sell-off? Let's dig into this a little bit more. Well, again, to start off, we can see, like we pointed out, revenue's up by about 12%, and we have the 3 different business segments. Productivity and business processes saw about 14% growth. Intelligent cloud, we have 19% growth. And then more personal computing. This is one of the smaller segments, but they didn't really see any growth in this segment. We didn't really see any change in the gross margin percentage. And to put that into perspective just a little bit more, let's jump back over to my profitability sheet and plug in Microsoft. And what we can see is gross profit ratio over the past decade has remained pretty steady, but it's even seen some slight improvements from the 10-year average of 67%. Last year, it came in at about 69.76%. So this is a high margin company. Now, if we look at some key highlight, we can see cash return to shareholders. People don't typically think of Microsoft as a dividend stock, but they've been reliably paying out and growing that dividend payment for a long time. We can see they returned $9.7 billion to shareholders, with $6.2 billion in dividends and $3.5 billion in share repurchases. So look at the dividend perspective for this company. Low starting dividend yield sitting at just 0.7%, but the past decade, they've seen tremendous dividend growth. 10-year dividend CAGR of about 9%, and if you zoom out even more, you're going to see the dividend CAGR gets even higher as you look back. But here's what's impressive. The free cash flow growth has been much higher than the dividend growth. So as a result, they're using less and less of their free cash flow to pay out dividends. And that's very important because they're about to go through a period of higher levels of capital expenditures. Obviously, the big story over the past week was the DeepSeek release. And how is that going to impact semiconductor stocks and potential AI stocks like Microsoft? Well, here's what we know. From the most recent earnings report, they stated, we expect capital expenditures to increase in coming years to support growth in our cloud offerings and our investments in AI infrastructure and training. And this was a bigger statement than a lot of people realize. What they basically told us is nothing is changing. If we jump over to my quarterly data tab and look at Microsoft, if we look at CapEx per share, we can see it has ramped up dramatically, specifically over the last couple of quarters. And what they're telling us is this is going to continue to be the case. They want to be a leader in AI. Nobody wants to get left behind. So perhaps some people are bearish on that news. Some people might not like that with the recent news of DeepSeek, but there's still a lot of unknowns, especially when it comes to DeepSeek. And so because they're ramping up capital expenditures, we do have to understand free cash flow is going to be a little bit lower. Free cash flow was $6.5 billion, which was down 29% year over year, reflecting higher capital expenditures to support our cloud and AI offerings. So they're heavily investing for future growth right now, and that's going to be reflected in free cash flow. So you have to understand what's going on there. It's important to have that context when you're looking at free cash flow charted out over time, especially as we get more data in the coming quarters. Now, if we take a moment to look at their select products, I'm going to show you one of my favorite things about Microsoft. Microsoft is essentially a tech ETF in itself. It's like it has multiple tiny businesses all wrapped up into one. And the best thing about this is most of their mini businesses are seeing double-digit growth year over year. For example, look at Microsoft Cloud revenue, up 21% year over year. Look at Dynamics 365 revenue, up 19%. Azure and other cloud services revenue, up over 31%. And for the most part, we're looking at healthy growth rates all across the board. Now, it is also worth noting that Azure results fell short of expectations. Now, it is worth noting that Azure results did fall short of expectations. But the thing is, if we scroll down, we can see Microsoft said Azure revenue grew by about 31% year over year. And for me personally, a slight miss on something like that just isn't enough for me to think it warrants a sell-off. We have to keep in mind, we're talking about one of the highest quality businesses in the entire world, that despite its success over the decades, it's still in the growth stage. It's still growing earnings at double-digit rate. The same is true with revenue. Return on invested capital is very high, and it's extremely profitable. We're talking about around a 69 to 70% gross profit ratio. And if we look at the balance sheet for Microsoft, we can see they're in a phenomenal position. They have a massive cash position despite the acquisition they recently had with Activision. We can see their interest coverage ratio at the end of 2024 was sitting nearly at 40, meaning their earnings before interest and taxes could cover their interest payments nearly 40 times over. So in my opinion, there's nothing to be worried about with Microsoft. This sell-off is completely unjustified. The only argument for sell-off you could make is if you're looking at it purely from a valuation perspective. Maybe Microsoft does trade at a premium, but in my opinion, they deserve to do so. And then finally, we come to Meta, the new Dividend stock, and it's up by about 1.5% in after hours. And then finally, we come to Meta Platforms, up by about 1.5% in after hours, trading at $676 per share. And what a year it's been, up nearly 68%. And if we start to dig into this earnings report, we can see they saw beats on top and bottom lines. Q4 GAAP earnings per share came in at about $8.02, which was a huge beat by about $1.26. And then revenue came in at $48.39 billion, up 20.6% year over year. It was a beat by about $1.4 billion. And if we jump over to Meta Investor Relations website, let's get some key takeaways. To start off, we can see daily active users, a pretty key metric for a stock like Meta, saw an increase of about 5% year over year. And then one of the key highlights, capital expenditures. Again, just like we saw with Microsoft, this is going to be a key item lots of investors are looking for. But what we can see is capital expenditures, including principal payments on finance leases, were about $14.84 billion and $39.23 billion for the fourth quarter and full year 2024, respectively. Now, if we scroll down a little bit further, we can get more insights. Right here, they state, we anticipate our full year 2025 capital expenditures will be in the range of $60 to $65 billion. So again, let's put that into perspective. Revenue for 2024 came in at about $164.5 billion. So they're making massive investments into capital expenditures. Again, nobody wants to get left behind in the AI race. But now let's touch on the capital return program. Share repurchases of our Class A common stock, $29.75 billion, and total dividend and dividend equivalent payments were about $1.27 billion and $5.07 billion for the fourth quarter and full year 2024. So let's look at them from a dividend perspective, even though it seems kind of silly since they just started paying. What we can see is the current dividend yield for this company sitting at just 0.3%, but I do want you to keep in mind, the free cash flow growth from this company is going to be phenomenal. Therefore, their dividend growth potential in the decades to come is also massive. When it comes to outlook, the company noted that first quarter revenue should be about $39.5 billion to $41.8 billion, making for a midpoint well under the consensus of $41.6 billion. And that reflects 8 to 15% year-over-year growth or 11 to 18% growth on a constant currency basis, as our guidance assumes foreign currency is approximately 3% headwind to year-over-year total revenue growth. Now, what's interesting is they didn't provide a full year revenue outlook, but instead they gave us this quote: "We expect the investments we are making in our core business this year will give us an opportunity to continue delivering strong revenue growth throughout 2025. So in regards to Meta's earnings report, I didn't see anything that should change investors' opinions about this stock. This is still a company rapidly growing its revenue, rapidly growing earnings, and with massive profit margins. The only question that we'll have to wait to see is if the massive capital expenditures will pay off. That remains to be seen. So there's a quick review on StarBucks, Microsoft, and Meta. It's interesting because StarBucks obviously was up by over 8%, Microsoft down over 4%. Both of those are stocks that I own in my portfolio, and it sounds like both of those companies are doing exactly what I expect them to do, and based off of that, it's important not to get flustered by short-term price volatility. But go ahead and let me know what you think of these companies and their earnings report in the comments down below. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.